It's been generally bleak for the junior resource sector, but there is a bright spot. I'm with Rick Rule, formerly with Sprott and now running Rule Investment Media. Rick, how you doing?
I'm doing great. It's a pleasure to be with you. Thank you for having me back on.
Rick, there's been a lot of blood on the floor in the resource space, but uranium stands out. I see Cameco is up 29% year to date. Sprott Physical Uranium Trust, which you may be familiar with, is up 13%. It just seems that uranium is having a string of good news.
Yeah, I think the malaise that you see in other resource sectors was a malaise that affected uranium for a very long time. Everything has its day. Of course, I've been fairly vocal about uranium. I believe that the good news in uranium continues, particularly with the pace of Japanese restarts, but also with uranium beginning to enjoy some popular favor, both because it's a material that generates baseload power without producing carbon, but also because of increasing concerns about the supply chain, particularly in view of both inflation and, of course, the war in Ukraine.
Let's talk about those precious metals. The GDX is down 21% year to date. It had that big move at the start of the year, talking again about the Ukraine-Russian crisis, but it gave it all back, Rick.
Yeah, in my experience, precious metals do move on fear. But in my experience, again, it isn't so much fear of war as fear about the efficacy of purchasing power in fiat-denominated instruments. This period that we're in now reminds me so much of 1970 and 1971, where incipient inflation, particularly inflation in excess of deposit interest rates, was on everybody's mind. But people had been through 20 pretty good years, which meant that concerns about inflation were academic rather than personal. By 1972, 1973, the circumstance had changed. And I think these circumstances changed too. The idea, as an example, in my country, in the United States, that you can get paid 3.5% on a 10-year treasury means with 9% inflation that you are guaranteed to lose 5.5 or 6% of your purchasing power compounded over time. The effect of this isn't immediately apparent, but when it becomes apparent, it goes from being, let's call it an academic concern, to a real concern, and gold does well. I'm particularly attracted, Michael, to the fact that the gold stocks, relative to their net present value at current gold prices, are as cheap as I've ever seen them in my career. The fact that, as I believe it, gold is set to do very well as a commodity, while the stocks are so cheap, seems to me to present very, very, very attractive opportunities. I'm so attracted to this, frankly, that at age 69, I'm starting a new bank. And one of our activities will be to lend against holders' physical gold. I think I and they will both do very well. But it's a mark of my optimism around the gold price that in retirement, I'm actually starting a new bank that'll be a gold bank.
Let's keep with macro, Rick, but I really want to get back to talking about the junior resource space. But we had what happened with Jerome Powell and the hawkish statements that happened with the Fed. You said in a note, again, following up on what you're talking about, is you need to be paying attention to these credit markets.
I think you do. On the one hand, Mr. Powell has, I think, correctly allowed interest rates to begin to rise. But to call him a hawk, I think, is a bit of an overstatement. The idea that you have deeply negative real interest rates means that people need to change the way that they invest. Of course, any rise in interest rates will strengthen the US dollar, which is, of course, what happened. And any rise in interest rates in terms of equity markets is almost always bad. You raise the company's total cost of capital by increasing the price of debt at the same time that you reduce the capitalized value of their income stream because of higher competing interest rates on other products. So certainly a rising nominal interest rate would be bad for, as an example, single family homes. It would be bad for equities. It would be disastrous for long bonds. These will be interesting times, Michael.
Goldman Sachs had that note talking about you want to get into commodities, but I think this kind of goes to your point, Rick, whereas is that you want to be in commodities by default, that you do not want to be in equities because given this environment, with recession, with rising interest rates, that commodities is just going to be the best place to be.
I think there will be opportunities in equities. I have never regarded the stock market as a thing or a source of information, but rather as a facility to buy and sell fractional ownership in businesses. And I note even among the broad markets that there are opportunities in smaller cap names that have been orphaned by the institutions. But I follow what you're saying. The truth is that we've experienced, I would suggest, 3 decades of underinvestment in natural resources. And you can't make up that 3 decades of underinvestment in a couple of years. We have impending shortages really across the supply chain in natural resources. Could this be disrupted for a couple of years by a recession? Of course. But the truth is, as an example, in oil, we're still underinvesting by $1 billion a day. This underinvestment, supply chain inflation, and absolutely moronic policies, both in the United States and Canada, with regards to domestic natural resource industries, but particularly energy industries, will have the ironic impact of making resource investments work out better than they otherwise might.
Well, let's, there's what was interesting, Rick, that you sent me a note before interview and you said that you like the microcaps, but isn't a microcap by definition something that is not going to be ready for about another 10 years right now? There is a need for commodities right now, given what you're talking about, the themes in terms of underinvestment.
I like to ask my former clients to invest in probabilities and speculate on possibilities. For the last sort of 3 years in my Kitco interviews, I've suggested that the microcap stocks were overpriced on a risk-adjusted basis compared to larger cap names. The very underperformance of these microcap names, where many of them are off 80% in the last 12 months, has meant that the risk-reward parameters have been readjusted. One of the facets that you see as a consequence of 3 decades of underinvestment in natural resources is that many of the big companies have substantially underinvested in exploration. And to the extent that a junior makes a legitimate discovery, the multiples that are beginning to be paid in the M&A market are eye-popping. What has changed is the price of admission. In a select group of juniors, I would suggest that investors have thrown out the baby with the bathwater. And particularly, Michael, for your listeners that are accredited and have the ability to take place in private placements, the terms that are on offer in private placements are the best terms I've seen in 3 years. For 3 years, the capital markets terms favored the issuers. Now the tables have turned and they're beginning to favor the check writers. And as a check writer, I think that's a wonderful state of affairs.
Commodity groups, geoposition, anything that you like to focus on within that area, Rick?
Well, I think for Canadians in particular, the Canadian oil and gas sector, although it's had a hell of a run, has further to go. Canadian natural gas on a cost basis is the cheapest in the world. Yes, your government has scored some own goals trying to defend Canadians against Canadian wealth. But the truth is that resource base and that talent base in Canada is going to continue to deliver wealth for a very long time, Mr. Trudeau and Ms. Thornburg notwithstanding. But in truth, I see attractive opportunities really throughout the natural resource space. I guess the thing that is particularly of use to Kitco readers is the fact that the gold stocks, as I say, in terms of net present value relative to the price of gold, are the cheapest that I've seen in a 49-year investing career.
How do you speculate on the juniors and the battery metal space? So, Rick, if you're buying into the theme on that, there seems to be no end of metals. It seems that the sun seems to shine on one particular metal before you have some type of substitution. These guys seem to be building bespoke chemistry plants or chemical plants for the end run on this. Do you wade into this, or do you just throw up your hands and you just buy copper?
I think buying copper and buying nickel are good things to do. I believe that the narrative goes in and out of favor. My favorite thing to do is buy a suite of materials like battery metals after they have become popular, when the bloom comes off the rose, when companies are beginning to deploy capital that they bought at prices that are substantially higher than the current prices, and you can take advantage of successful efforts. It's always important, Michael, to remember that speculation is extremely risky. It's important to remember, too, that of the 2,500 or 3,000 junior resource companies worldwide, probably only 250 or 300 have any value whatsoever. So it's important that when somebody attracts themselves to a theme, be it battery metals or copper or gold, that you understand that more often than not, you have to say no to an investment. Don't look at a company because they purport to be in the gold business. Do your due diligence. Find companies that are enjoying good exploration results. Find management teams that have been serially successful in activities that closely resemble the task at hand. If you do that, when that commodity is out of favor, not in favor, out of favor, when it's on sale, you will do well over time.
Is the U.S. a hard place to build a mine, Rick? I was thinking of Hudbay's Rosemont in Arizona and Twin Metals in Minnesota.
The U.S. is a very hard place to build a mine. If you are in a jurisdiction other than Texas, Nevada, Wyoming, or Alaska, I think you have to proceed with extreme caution. America is proud of its mining history, but the mining present begins to weigh on investors. My own rule is that any mine built in proximity to a community where they spell shop, SHOPPE, is probably a difficult place to build a mine. My home state, my former home state, California, of course, included.
Rick, I'd like to finish with some good news. In another interview, you said that there was a diverse crowd at your annual conference, which was moved from Vancouver to Boca Raton. What's going on?
Well, we had to move to Boca Raton. My preference would have been to have my conference in Vancouver. But the truth is that public health challenges and public policy challenges on both sides of the border meant that I would have had to subject my client base to the ArriveCan app. And that would have resulted in border issues that I'd prefer not to be responsible for. What was really lovely about Boca Raton is, amongst all the gloom in resource markets, a lot of people showed up and probably had the deepest engagement that I've ever seen at a conference. That may have had to do with the fact that it was 90 degrees Fahrenheit outside with 100% relative humidity. It was much less tempting to play hooky in tropical Boca Raton than it would have been in a Vancouver summer. But the truth is that the engagement I had was very deep. The second thing, Michael, that's really interesting is that the median age of the attendees was probably 20 years younger. The spread of the natural resources and free market narrative through social media has been the key to the natural resources and hard money movement, attracting a whole new generation of adherents. Adherents not just in the United States and Canada. We had attendees from Europe, we had attendees from Africa, we had attendees from Latin America. So the demographics of the natural resource investment arena are certainly changing, and from my point of view, for the better.
Rick, we'll take the added interest.
Well, I think that does actually benefit Kitco. I think you have mastered over 20 years accessing social media, and I suspect that you're partially responsible for the resurgence of younger investors and female investors that are beginning to grace the space.
Rick, we appreciate it. Thanks for your time.
Thank you. I should also mention, of course, that Kitco will be hosting, as I understand it, the ultimate gold panel involving at least Frank Giustra and myself coming up. So I hope that your listeners will stay tuned to the ultimate gold panel. What really attracts me is the timing of this panel with, as I say, gold equity prices not reflecting anything like the current gold price.
Rick, thanks for your time.
Thank you so much for the opportunity.
He is Rick Rule. He is running Rule Investment Media. My name is Michael McCrae, and you've been watching Kitco Mining.